Well, investors are weighing the minutes from the last FOMC meeting. And while those minutes did reveal that some members wanted to leave rates unchanged, officials are still thinking that inflation is too high and more rate hikes may be necessary. For more on what this means for the markets, we want to bring in Mahmood Noorani, CEO of Quant Insights. Mahmood, great to see you here. So let's compare what the Fed is telling us, at least the minutes, what we're learning a little bit more about the discussions that were taking place ahead of the Fed decision last month, and comparing that to what the market believes, because by and large, the market is still expecting or still optimistic that the Fed's done raising rates. Is the market being too optimistic with how they're reading the Fed's possible moves?
Yes, I think the market has been too optimistic. And you've got to bear in mind that in a good decade after the financial crisis, financial markets got used to very low inflation for a long period of time. And so that mindset is very much there. And equity markets have been pricing this soft landing or Goldilocks scenario, if you want to call it that, for some time. The Fed has continued to push back against that. And this is the latest pushback. And I expect more pushback as we get to Jackson Hole.
Mahmood, the minutes, though, today, does that change your base case in any way? I mean, the reality is, if you think back to the last press conference from the Fed chair following the FOMC decision, it really was about optionality. He's never ruled out another rate hike.
Correct. And I think there's two camps at the Fed. There's one camp that is basically going to focus on how long rates need to stay at these levels in order to cool the economy down. And there's another camp that I think these minutes show is quite strong, which doesn't believe that the current rate level, even for a long period of time, is going to be enough to bring inflation down to target. And let's face it, we've been expecting a recession given the inverted yield curve for something like a year now. There is no recession. Real GDP growth in Q3 is tracking something like 2%, according to nowcasting. Unemployment is at historically very low levels. Average hourly earnings actually ticked higher from 4.2 to 4.4%. Core inflation is close to 5%. If you look at the hard data, there really isn't any clear sign that core inflation is going to head south. And we know the story behind this. We have very strong service sector inflation. The service sector is a very big part of the US economy, probably 2/3. And, wages are rising too fast for the Fed's comfort level.
So then, Mahmoud, what does that mean just in terms of the timeline here, the Fed's fight against inflation? How long could that potentially take if we were to ever see it come back to that 2% target?
I think we're much earlier in that process than the market thinks. And what's really driving that is that a good part of the core inflation we are seeing is structural rather than cyclical. In fact, the San Francisco Fed published a paper a few months ago showing that something like 2/3 of the core inflation rate right now is structural. And those structural forces come from things like demographics, 100,000 baby boomers retiring every week, immigration levels much lower than 5 to 10 years ago, deglobalization, shifts away from fair trade and towards, shifts away from free trade and towards fair trade. And of course, we have moved away from offshoring and we are now much more focused on onshoring. And so all those structural forces, I think, are the things that the market isn't really fully appreciating. And I would expect rates to stay unchanged into next year or potentially higher, depending on wage growth.
We are right in the heart of retail earnings this week. We've gotten a better read on the consumer. Based on what we have heard from some of these big names, what we keep hearing, Mahmood, is that the consumer is cautious, but that some confidence is returning. I mean, what is your read based on what we have heard so far?
Yes, the U.S. consumer has been surprisingly strong. I think if you had asked people 18 months ago what would happen if rates went from 0 to 5.5, they would not really be expecting the current strength of the U.S. consumer. And what's really remarkable in the U.S. is how interest rate insensitive the economy is. And that really comes from two places. Number one, throughout the COVID period, corporates locked in a very large amount of debt at low levels. And something like 60% of that debt is locked into 2030. So they're not really, they've insulated themselves against the interest rate increases. There's also been a lot of focus on the US consumer increasing credit card debt to keep going, and that hit 1 trillion recently. And the 35 million Americans who own their home outright is also an area of focus. And I think there's been a little bit of a mystery. Why is the consumer so strong? And I think there's been a bit of an attitude shift. You know, consumers, there's the whole sort of COVID revenge travel season going on. Travel prices are up 30 to 40% in the US and in Europe. A lot of the travel and leisure sector is on fire. All the hotel groups have done very, very strongly. Booking.com, Hilton, Marriott, Intercontinental. And so I think the consumer to some degree is living a little bit on borrowed time. And all those chickens may come home to roost later this year.
So then what would that potentially look like?
I think that would look like a stock market that goes from pricing this soft landing to a stock market that starts to actually rotate away from cyclicals and towards defensives. And of course, there are global forces at play. If you look at the data out of China recently, it's been really awful. Manufacturing production really collapsing there. Imports down, exports down, home prices down, the currency weakening. China is, of course, the second largest economy in the world. The Eurozone, which is heavily geared to China, is weakening in terms of growth. It was interesting that Siemens in Germany recently said that their order book is down 60% from China. So I think there's an element of sort of the roadrunner economy going on in the US. And the Fed is clearly saying that there's not going to be any easing. Just take that off the table for the rest of the year, given the information we have.
So Mahmood, then what does all this mean for positioning? You talk about the fact that there is so much risk out there. Maybe we could see this rotation out of cyclicals. How should investors be preparing for what sounds like a very uncertain several months?
Yeah, I think the obvious plays are to reduce exposure to interest rate sensitive sectors. You mentioned real estate wasn't having such a great day today. Reduce exposure to cyclical sectors such as travel and leisure, and move into the more defensive sectors like utilities and consumer staples.
When we're talking about retail, what's your positioning in retail? What are some of the names that you like?
I haven't got a good answer on that one. I haven't really looked at the names in that sector recently, so I can't be too helpful. Sorry.
All right, Mahmood, Noorani, always great to get your perspective. Maybe next time we can get some of your specific picks on retail. Great to have you. Thanks so much.